So we had a little bit of a snapback rally last week. We did see the S&P 500 open higher on Monday, although it wasn't quite as strong as I think many people were expecting. In fact, the previous highs were basically the wall for the entire week at 54.50. And then, of course, we ended up moving down on that Thursday into OPEX. And then here on Friday, you can see we had that little bit of a rally, but all that was really given back by day's end with the impact with the S&P basically finishing flat. And when you look at the S&P 500 versus, let's say, the Japanese yen, I mean, there certainly has been a strong relationship between the two over the last several months. And you can really make the same argument when looking at things like even the Swiss franc. So what this is kind of implying to us is that a lot of what we're seeing in this market right now continues to be sort of the movement away from U.S. assets. And this continues to be the overriding theme, I think, in the markets. But the problem here is that the dollar is at a really important spot and very close to breaking down through some major support levels. This chart's a little messy, so let's try to work with a clean slate. And when we look at the broader views of the dollar index, what this is really showing us is the dollar is really at an important spot here. And if it breaks, let's say, below this 99 level, I mean, we're talking about setting up a move to, the upper 97 range, but really it looks like there's much more of a chance of us moving back into the mid 90s. And this would be the equivalent of like the Japanese yen breaking support at around 141 or so, potentially moving down to around 137 and a half, and maybe ultimately down to around 130. And it's the same thing with the euro, where you have the euro, which is, now broken some major resistance at 112, while the euro is now testing resistance at around 115. And really, you can't rule out a potential return all the way to around 122 or 123, because really after 115, you have one major area around here, around 119. And then, of course, again, up here at 123. And it's really the same story when you're looking at the pound. The pound has also been really strengthening materially and very close to breaking out above resistance, also potentially moving, all the way back towards 137. So what you're seeing is, basically the dollar continuing to lose ground against most of these major currencies. And this is really, again, a sign of repatriation and exit from U.S. asset classes. And one of the reasons, you can kind of come up with this conclusion is when you look at things like the U.S. 10-year minus the Japanese 10-year, what you see is you take the U.S. JPY and you overlay the two charts. And what you'll see is that more recently they've diverged. So after, a very, very long period of basically highly correlated trades, you've seen that they've really now diverged. And I'll try to make this a little clearer, but you can see that right here, that this has clearly been coming down. This means the Japanese yen's been strengthening while the spread between the US 10-year and the Japanese 10-year has actually been rising. Again, a sign of what I would think means that market's not really paying attention to interest rate differentials at this point. It's really very similar when you look at the German 10-year versus, say, the euro, which is also kind of seen a really big movement. So when you look at the euro versus the rate, you have to do it inversely to get the effect of what it would look like. But you can clearly see that we're no longer trading with the interest rate differential. In fact, they've both gone in opposite directions. And so again, what this is kind of implying to me is that the market at this point is no longer really concerned about that. Here it's the same thing where you're again seeing the markets divergent from one another. And so what this kind of implies to me is that, as long as you continue to see the dollar continue to weaken, I think that's going to be a negative indicator for where the U.S. equity markets are going to be going. And, can you kind of think about it? It's probably one of the reasons why as the dollar has been strengthening during, certain periods of time, we haven't really seen financial conditions tighten all that much, and it's been falling. In fact, it's funny because a lot of people on social media have been talking about how the dollar falling is adding liquidity to the system and helping financial conditions ease. But really what's really going on here, though, is that the dollar is falling and financial conditions are tightening because credit spreads are widening and financial conditions aren't responding to the easing of the dollar. This is actually, again, sort of, while people may view this as risk on, this is actually risk off. And that's that's a really big misunderstanding that you're seeing right now in markets. So, I mean, when you look at the S&P and you kind of think about what's been happening in it, especially when you start looking at, the futures are a good example and if you just add the Japanese yen to it, you can see pretty clearly the relationship between the two has been really strong of late, and they basically just trade with one another. And it's the same thing, obviously, with the NASDAQ. But you also have to realize too that, when you have a situation where stock prices are going down and you have the dollar weakening, when you're a foreign holder, depending upon how you're hedged, if you're hedged, not everyone hedges their FX, you're not only losing when the market's going down, but you're also losing from the FX changes. So like if Nvidia's price does nothing over the next several months and you see the yen continue to strengthen to 137 and then 130, if you're a foreign investor and you're still holding Nvidia in US dollars, but you need to eventually repatriate that, well, I mean, you're looking at a 3.5% additional loss and then potentially up to an 8% additional loss just from the currency strengthening and eventually having to bring that money home. So actually by doing nothing and the dollar continuing to strengthen, to weaken, you can actually see your losses expand. And so if you're a foreign investor, again, you may be incentivized to move your money out faster if, you continue to see that happening. And so that's basically why you're seeing, I think, the two trade together. And really more importantly, when you look at the S&P 500 overall, I mean, what we're sort of looking at here is just what looks like these big impulsive waves down with these sideways consolidation phases, which is what this is and what this appears to be at this point. And what this would imply to me is that we're probably still looking for another leg lower in the market. And really the key area in here is probably going to come somewhere around this 5280 region. And if we were to break that level, I think you're going to see us potentially return all the way back to the lows and maybe even undercut them. It depends upon, a lot of factors, but you can see how that level sort of lines up with where we are in the dollar index right now, and how if the dollar continues to weaken, that could really pressure S&P 500 futures and index lower. And it really comes at the same time that you're seeing the 10-year rate in a very unfavorable position too, because what the 10-year rate has basically done is that it managed to break lower and actually fall all the way back into the 390s, but then it came right back up. And here you can see it settling again in this range that has been a support region now for some time. And when you look at the 30-year, it's also a very similar situation where this 480 region has been an area of some importance really going back also for some time. So again, you saw the same thing happen where where it looked like we were going to break lower and then we came back up, and now we're kind of just consolidating at what has been an important area. And so you're in a situation where, if you continue to see these outflows and you're going to continue to see a scenario where the dollar is going to continue to weaken, and the weakening is a sign of U.S. assets being sold, you can actually see bond yields continue to rise in the U.S., the dollar weaken, and stock prices go down in conjunction. And that sort of makes like a triple whammy for, U.S. assets getting potentially hit pretty hard over the next couple of weeks. It's really all going to depend upon, how this is going to play out as we move forward. Anyway, I hope you have a great rest of your weekend, and we'll see you again soon. Bye.